Investing can be a daunting task, often accompanied by a plethora of choices, risks, and uncertainties. While many people venture into the world of investments with high hopes of financial gain, they often make critical mistakes that can lead to substantial losses. One common mistake is lack of research and knowledge. Lack of research and knowledge is a critical mistake often made by novice investors, and it can have detrimental consequences for their financial well-being. When individuals venture into the complex world of investments without a solid understanding of fundamental concepts, they essentially navigate blindfolded through a maze of financial options. Without awareness about the diverse types of assets available, ranging from stocks and bonds to real estate and cryptocurrencies, they lack the necessary insight to make informed decisions. Additionally, not understanding their own risk tolerance, the level of risk they are comfortable with, can lead to investments that are either overly conservative, potentially hindering potential gains, or excessively aggressive, exposing them to unnecessary risks. In the absence of adequate knowledge, investors become susceptible to impulsive decision-making. They might fall prey to market rumors, react emotionally to short-term fluctuations, or rely on unreliable sources of information. This impulsiveness can lead them to make hurried investment choices without thoroughly evaluating the risks and rewards. For instance, driven by a sudden surge of enthusiasm or fear due to a market trend, they might buy or sell assets hastily, often at unfavorable prices. Emotions like fear and greed can cloud judgment, causing them to ignore long-term considerations and focus on immediate gains or losses. Number 2. Overconfidence. Overconfidence represents a significant pitfall in the world of investments, affecting even seasoned investors who have experienced initial success in the market. When individuals achieve early gains, they often develop an unwarranted belief in their ability to predict market movements accurately. This overconfidence can be perilous, as it leads them to underestimate the complexities of the financial markets and overestimate their own capabilities. Consequently, they start taking excessively high risks, assuming they can beat the market consistently. This overconfidence-driven behavior manifests in several detrimental ways. First, overconfident investors may dismiss warning signs and downplay potential risks, believing their judgment is superior to market fluctuations. They might overlook crucial market indicators, economic signals, or geopolitical events that could impact their investments adversely. Second, and equally damaging, overconfident investors tend to neglect the principle of diversification. Diversifying a portfolio by spreading investments across different assets and sectors is a fundamental risk management strategy. However, overconfident investors might concentrate a significant portion of their investments in a single asset or a specific market sector. By doing so, they expose themselves to higher levels of volatility and potential losses if that particular asset or sector experiences a downturn. Number 3. Emotional decision-making. Emotional decision-making stands as a formidable adversary in the realm of investments, influencing choices and outcomes more profoundly than many investors realize. Human emotions, particularly fear and greed, wield significant power, often clouding rational judgment and prompting impulsive actions. In times of market downturns, fear can grip investors, causing them to panic and hastily sell their assets. This fear-driven behavior can result in locking in losses, as these investors fail to withstand the emotional pressure and lack the patience required for the market to potentially rebound. On the flip side, greed can lead investors into risky territories. Driven by the desire for high returns, they might overlook or underestimate the associated risks. This over-optimism can push them towards speculative or volatile investments that don't align with their overall financial goals or risk tolerance. Succumbing to these emotional triggers often leads to poor investment decisions, disrupting long-term strategies and eroding potential gains. Recognizing the influence of emotions on decision-making and developing the discipline to counteract these impulses is crucial for investors to maintain a balanced and informed approach, allowing them to make decisions based on logic and analysis rather than succumbing to the erratic sway of emotions. Another mistake that investors commonly make is market timing. Market timing is a tempting yet treacherous endeavor that many investors undertake, often to their detriment. The concept revolves around trying to predict the ideal moments to buy or sell assets within the financial markets. This practice is commonly driven by short-term fluctuations, news events, or economic indicators that investors believe can provide a competitive advantage. However, accurately forecasting market movements consistently is an elusive goal, even for seasoned financial professionals. One of the significant challenges with market timing is that it requires both pinpointing when to exit the market before a downturn and re-entering when conditions are favorable for growth. The difficulty lies in the unpredictability of market dynamics, as they are influenced by a multitude of factors, including economic data, geopolitical events, investor sentiment, and more. As a result, attempting to time the market often leads to missed opportunities and increased trading costs. When investors attempt to predict market turns, they may find themselves sitting on the sidelines when markets experience unexpected gains. Moreover, the frequent buying and selling associated with market timing strategies can lead to higher transaction costs, which can erode overall returns. These costs can include brokerage fees, taxes on realized gains, and the bid-ask spread, all of which reduce the profitability of an investment portfolio. Number 5. Neglecting to diversify is a fundamental mistake that can have severe consequences. Diversification, the strategy of spreading investments across different asset classes, sectors, and geographic regions, is essential for managing risk. Investors who put all their money into a single type of asset or a specific market sector face significant risks if that asset or sector performs poorly. Diversification helps mitigate the impact of a poor-performing investment on the overall portfolio, enhancing the potential for stable long-term returns. Number 6. Ignoring the impact of fees and expenses. Overlooking the impact of fees and expenses ranks among the most overlooked yet profoundly impactful mistakes made by investors. Many individuals fail to fully comprehend the implications of management fees, transaction costs, and various other expenses associated with their investments. While these fees might seem inconsequential in the short term, their cumulative effect can significantly erode investment returns over time. Management fees, charged by mutual funds, ETFs, and other managed investment vehicles, are calculated as a percentage of the assets under management and can substantially reduce the overall profits earned from investments. Number 7. Failure to have a clear investment plan. It is a mistake that leaves investors directionless and susceptible to impulsive decisions. Without a well-defined investment plan that outlines financial goals, risk tolerance, and a diversified strategy, investors are more likely to make decisions based on short-term market movements or external influences. A clear investment plan provides a roadmap, helping investors stay focused on their objectives and avoid making hasty, emotion-driven choices that can negatively impact their financial future. In conclusion, avoiding these common investment mistakes requires education, discipline, and a long-term perspective. Investors should prioritize continuous learning, conduct thorough research, and seek advice from financial professionals to make informed decisions. Embracing a diversified approach, managing emotions, and having a well-defined investment plan are key steps toward building a successful investment portfolio. By being aware of these pitfalls and taking proactive measures to avoid them, investors can significantly improve their chances of achieving their financial goals and securing a stable financial future.